We've got to take a look at the state of retail and the consumer here. We're watching Walgreens stock as it falls in pre-market trading. The pharmacy giant reporting third quarter results, beating on revenue but missing analyst expectations on earnings for the first time since July of 2020. Walgreens also slashing its full year earnings guidance. That's now looking for a range of $4 to $4.05 per share for the full year of 2023 versus $4.45 to $4.65. That was their previous outlook here. So a few things that, of course, for us to remember about this company when they do report, it's also not just the healthcare segment, but also that retail segment. And that's where you can see a little bit of choppiness, perhaps, in where the consumer is purchasing within some of the stores.
Well, the company, it's interesting at this stage, but the company is really calling out COVID-related services at this point as being an area of shortfall. And I say it's interesting at this point because here we,
like a year removed from everybody going to get vaccines.
In other words, of
Walgreens.
course you're seeing a drop in demand for this stuff. So it's interesting that it wasn't sort of more modeled for, I guess. But at the same time, CEO Roz Brewer in the statement also talked about a more cautious and value-driven consumer. And she said a recently weaker respiratory season created margin pressures in the quarter. So what's good for all of us, I guess, is not necessarily good for Walgreens. In other words, people didn't get colds as much, right? I guess is what she's saying. And so that means that it wasn't as strong for the company. They're doing their conference call now, I believe, and accompanying that was a set of slides. So they actually gave a forecast for the full year, excluding the effect of COVID and FX, which is interesting, and said that adjusted earnings per share will be flat to up 1% if you exclude those items.
Yeah, particularly interesting for Walgreens as well here is, the companies in the wave of consolidation that we had seen roughly 2017, early 2018 within the healthcare landscape, trying to merge some of the PBMs along with healthcare insurers, that was to make sure that when more people lean into insurance, essentially, it's kind of a barbell approach where you've got the retail on one side that will do well as a standalone in times where consumers are gleeful or at least continue to spend in that retail side of the business or on the pharmacy side as well. But then additionally, on the insurance side, being able to take advantage of a time like this where more people are opting into getting the elective surgeries that they did not get or having more of the routine check-ins. So leaning more into that insurance side. But for Walgreens, they don't have that same type of add-on exposure or at least benefit that some of the other PBMs had strategically been able to kind of put together some landmark deals around. So that particularly interesting. You'll see where they have to kind of net out some larger insurance deals going forward from here. They mentioned one with Blue Cross Blue Shield. But again, these are still some of the partners of theirs rather than being owned entities.
Yeah, exactly.
Well, Walgreens cut its full-year guidance following CVS footsteps last month, reflecting higher costs and a pullback in consumer spending, hitting several retailers this quarter. So what does this mean in this forecast for next earnings season? We're bringing back in Anna Han, who is the Wells Fargo Securities Equity Strategist, and Jonathan Boyar, who is the Boyar Value Group President. And I'm going to go to you first on this one. What does this foretell, perhaps, for where the next quarter of earnings should set in or at least kind of push expectations from the investors?
Oh, we'll say it's still early in the season, but something that I think they specifically mentioned is that the consumer is becoming more price conscious. That's been a trend we've been seeing, and we think it's going to continue. And what we've seen with top line margins, top line sales has been that it's been declining on a quarterly basis at a much more rapid rate than I think a lot of the consensus on the street is expecting. So if that continues, you can imagine how much is already declining on the top line. We continue to see margin compression. So that bottom line earnings number that corporates are able to take home has been shrinking faster than a lot of the consensus has projected for this year. So it makes us bring back to our conversation that Jonathan and I were having earlier about valuation. How can this market continue to trade on such a fat multiple when you're seeing that the actual EPS value that should be driving the market is shrinking faster? So our outlook really is that we're cautious on earnings. We do think that the earnings decline, or perhaps I would say, quote unquote, earnings recession, comes before we see that GDP recession.
Well, the stuff that's trading on a fat multiple, the earnings look a lot better. I'm generalizing, right? But something like Walgreens doesn't have a fat multiple, right? It's pretty cheap, and I guess you could say maybe justifiably so. So I guess in this market, Jonathan, how do you find something that is actually growing but is cheap?
That's the billion-dollar question.
Yeah.
I mean, that's one of the reasons. To your point about insurance companies is why we prefer CVS over Walgreens, because it has that kind of anchor. Although they've had some unforced errors over the past year, but you're now buying a stock at 8 or 9 times earnings that has a nice dividend yield that's delevering. So there's a lot to like on the story. But it is interesting, their comments. I wouldn't extrapolate it to everyone that the consumer is trading down or is being more budget conscious. But you just want to buy and look for good companies that have good value that people want to spend money to, like a company like, let's say, Topgolf Callaway Brands, which we talked about last time I was on the show, is
he wants to spend some money there. I know that.
Oh, it's a great experience. Top notch.
Top notch.
Topgolf.
And it's also a cheap stock. And I was there this weekend. You spend. It's a great business. It's growing. Same store sales are up about 11% per year. The stock is trading like a golf equipment maker instead of a fast-growing entertainment concept. So you just have to pick your spots, and you don't have to buy everything. And sometimes you get what you pay for. You have to be very careful. I wouldn't want to have a portfolio just consisting of 8 times earning stocks, because you're going to get a lot of broken stories.
Do you see any recess, or at least receding, in the resiliency among consumers that we've been hearing about over the course of last earnings season?
We've been hearing this for quarters, and right now you still have a very good employment picture. People are spending money. They're spending money on different things. They're spending money on experiences. Companies like Liberty Braves that we like, Atlanta Braves baseball team. People are still going to the ballpark, especially because they, unlike the Mets, are doing well.
and on this front also, it's interesting you talked about you guys like TMT stocks, telecom and media here. Is that something you continue to like? That's sort of the other side of this coin, right? People staying in and streaming maybe instead of going out and spending on various events.
Well, I think there's a mix that you see in that TMT space, specifically for us, why we prefer the media entertainment. So we think the valuations there, even though it's had a great performance year to date, almost keeping up with the QQQ, is that the valuations are still a little more reasonable than you see on some of the other parts of the tech sector. And it has this combination of, there are these experiences parts. It's not necessarily only tied to staying in, but it's most of the experiences versus having these durable or hard goods. At the same time, you're getting this combination of, you get that AI flavor in there. There's a lot of this exciting new technology, machine learning that these kind of companies are using. So a way to get exposure to that rather than chasing what you might have feel like a train that's already left the station is to look into that media and entertainment space. But I think the broad theme that we need to keep in mind here is, what is the consumer trend? Even as you go or expect a recession, or even if you expect some of other parts of the consumer to remain perfectly healthy and continue to spend as they have, then you need to think about what has changed post-pandemic and what's the consumer spending going to look like for the next 1, 2, 3 years. And that's going to really help guide the kind of sectors that you want exposure to, and find what is cheaply valued, but not cheap for a reason.